Whenever you see a company report these huge sales numbers, do you ever stop and wonder, what's really behind that number? Well, behind every earnings report, there's a really strict set of rules. And today, we're going to demystify IFRS 15. It's the global standard that completely changed how pretty much every company on the planet reports its revenue. Let's pull back the curtain.
So let's start with a basic question. When does a sale actually become a sale? Seems simple, right? You sell a thing, you book the money. But what if that sale includes a brand new phone, but also a 2-year service contract and some kind of discount? When exactly do you get to count that cash?
Well, the answer to that question is found in one single, really powerful accounting standard. And if you understand it, it's like having a special lens to see the true financial health of any company out there.
So here's our game plan. We're going to start by looking at what things were like before this rule. I'm calling it Revenue's Wild West. Then we'll dive into the new global rulebook and walk through the elegant 5-step model that brought order to the chaos. And finally, we'll talk about why this one rule really matters to all of us.
Okay, so before IFRS 15 came along, accounting for revenue really was like the Wild West. Seriously, different industries played by totally different rules. A construction company and, say, a software company could account for the exact same million-dollar deal in completely different ways. It made comparing them almost impossible.
Just look at this mess. You had one set of rules for construction, another for barter deals, totally different ones for loyalty programs, and yet another for real estate. It was just this patchwork of regulations, which meant an investor couldn't look at two companies in different sectors and make a fair comparison. This whole complex web is exactly what IFRS 15 was designed to just sweep away.
And this is where that new rulebook comes in. IFRS 15 introduced a single, comprehensive framework for everybody. No more separate rules for construction here and software there, just one core principle and a 5-step model that applies to everybody from a tech giant all the way down to your local coffee shop.
Okay, this is the heart of the whole thing. I know this quote from the standards sounds super academic and dense, right? But the idea behind it is actually pretty simple. You recognize revenue when you deliver on your promise to the customer. That's it. It's all about fulfilling your promises. And to make that happen, IFRS 15 gives us this really elegant 5-step model. Think of it like a universal recipe that every company now follows. Now, to make this feel real, we're going to follow a simple example, a company we'll call ConnectCo. They sell a smartphone bundled with a 24-month service plan, all for one price. Let's start with step 1. First things first, before you can even think about revenue, you have to have a contract. This is the absolute foundation of the whole process. If there's no valid agreement, well, there's nothing to account for.
And, a contract doesn't have to be some 50-page document with a wax seal. It can be verbal. It can even just be implied by the normal way a company does business. The key thing, the most important part, is that it creates rights and obligations that are legally enforceable. So, what about our ConnectCo deal? Does it pass the test? Well, the standard gives us a handy 5-point checklist. Are both sides committed? Yep. Can we identify everyone's rights and the payment terms? You bet. Does the deal have commercial substance? Basically, does it actually change the company's financial situation? It sure does. And finally, is it probable that ConnectCo is actually going to get paid? Yes. So, check, check, check. We officially have a contract. Step 1 is done.
All right, now that we have a contract, we can move on to the next 2 steps. And these are all about defining the deal itself. What exactly did ConnectCo promise to deliver, and what's the total price tag for all of it?
Step 2 is all about identifying the performance obligations. That's just the official IFRS speak for the distinct promises inside the contract. For ConnectCo, there are 2 promises here. First, the physical phone itself, and second, the 24 months of mobile service. And they are distinct because you, the customer, could use the phone on its own, and you could benefit from the service separately. This is such a great example of how IFRS 15 forces companies to unbundle their deals.
Step 3 can be pretty straightforward. We just have to determine the transaction price. So for our deal, let's say the total price for the phone and the 2 years of service is $1,200. This is our total pot of money that we now have to connect to those 2 promises we just identified. Okay, this is where things get really interesting. We've got our promises, we've got our total price. Now for the final 2 steps, which are the most critical. We have to split that price between the promises, and then, finally, we get to recognize the revenue at the right time.
So in step 4, we have to allocate that $1,200 price tag. The rule says you have to do it based on the standalone selling price of each item. Basically, what would ConnectCo charge for these things separately?
So if they sell the phone by itself for $600 and the service plan alone for $600, well, then our allocation is easy. It's a nice even split.
And now for the big reveal in step 5. This is the magic. Connecto recognizes the $600 for the handset immediately on day 1, because that's when they handed over control of the phone. We call that recognizing revenue at a point in time. But for the service, they recognize it over time. They take that other $600 and they spread it out evenly over 24 months, recognizing just $25 of revenue each and every month as they deliver that service. See the difference?
So why on earth do we just go through all that? Because this is so much more than just an accounting exercise. This standard fundamentally changes how we see a company's performance. It provides a level of clarity that builds real trust with investors, employees, anyone reading those financial statements.
I mean, the benefits are huge. We get transparency, so we can see how a company actually earns its money, not just when the cash hits their bank account. It gives us true comparability, so you can finally look at, say, Apple and Samsung and compare them using the exact same playbook. It's really more than a rule. It's a single global language for a global economy.
So the next time you see a headline about some company's massive quarterly earnings, you can look beyond that one big number. You can ask yourself, what promises did they have to fulfill to earn that money? And when did they fulfill them? Understanding IFRS 15 gives you the tools to see the real story behind the sale.